What's up, guys? We have a lot to talk about. Even since I've recently filmed the last video, there has been a lot of panic selling and seemingly drama in the market, whatever. Talk about my inspiration for this. I had dinner with my mom and dad and older sister. My dad's like, oh, the market's getting absolutely crushed or something. And I do want to hop on here and stress that as a dividend growth investor, that's really selecting individual stocks and finding, the best opportunities. I don't want to say you're going to be immune to the broader market, drama and conflict, but eventually in this game, you will just look at it as this. Okay, where's the opportunity? What's my move? And that's really, really something I've had to focus on in the time I've been investing, which is probably 7 years now. But before we get into this, we will look at my portfolio's rate of return. Okay, so I went over this last week. I wanted to pull it up again because, even only a week and a half later, it's gotten even more impressive. Okay. My account has had a cumulative rate of return of 18.49% from May 14th, 2024. Okay? That compares to the S&P 500's 8.76%. Okay? So in this time period, on a percentage basis, I've doubled the return of the S&P 500 and well outperformed the NASDAQ. Okay? So while it might seem like the markets are making a huge correction, as a dividend growth investor picking individual stocks, I'm always going to stay focused and I'm always going to stay kind of in my lane, in my bag. Where are the opportunities? Okay, I wanted to drive this home. This is not something to brag, but I did want to touch on it because I brought it up last video. Moving on, I am going to get into some live trading. Okay, and I'm going to be trimming 5 more shares of Apple stock, kind of as we've started to see. Okay, it seems like it's finally reversing, okay? It's finally kind of cracking below this 220 level. We'll see if it gets a close below. I'm going to take off my last tranche, my last sell tranche of Apple, and take my position from 35 long to just 30. Okay, I will be doing that now. And with these funds, okay, I'm going to reallocate and kind of go through where the funds are going, guys. Oh, not a buy. A sell. That would have been bad. Sell 5, not buy 5. And again, we see Apple down from kind of its all-time high of 260, from a charting perspective. And I did just take the shares off at 222. So you might say, oh, well, it's down. Okay, Apple's down from 260. I understand that, but with the time frames I'm kind of working on, I see Apple as, okay, it's still, it still has, hang on. It still has another 21% to fall until it's at that 200-week moving average, okay? Which, as you guys have seen, the 200-week moving average is definitely, a tool I like to utilize in kind of my long-term trading, okay? I do want to bring up another point, okay? And regardless of how much Apple has fallen, how much panic selling has happened, in the past, 3 weekly candles, I want to bring up, what do I use as my valuation tool, right? Or my valuation metric. I talk about this a lot. It's going to be price to cash flow on a forward basis. Okay, for Apple right now, that metric is sitting at 27.69 in comparison to its 5-year average of just 23.63. Okay, so that shows Apple is potentially 17% overvalued still compared to where it's traded at on a 5-year basis. Okay, so with that, with kind of my 200-week charting approach, in unison with my price to cash flow valuation approach, I still see Apple as having a lot of room to correct. And I still see, okay, there's better opportunities I can put my money into elsewhere in the market. Okay, does that make sense? And I do kind of want to stress one more time, this is not a situation where I'm panic selling. I've thrown that term around, but I began trimming Apple, in June of 2024. So this is not some emotional panic sell. This is kind of me taking, okay, my last tranche off of Apple. And the way I like to think about this, it's going to be this way, okay? So I preach on this channel, when you're building out a position, you're going to take kind of multiple buys, hopefully be a little early to the trigger, and hopefully kind of build that position out through, the consolidation or reversal period, okay? I like to think of trimming a position, such as I've been doing with Apple and Microsoft, in the past year. I think of that as the exact same, okay? The exact same approach. I'm not taking one, heaven forbid, I'm having to take off all my shares of a position at once. If that's the case, that probably means I've made, a pretty grave mistake, okay? So I do want to say this is not panic selling. And I do also want to reemphasize, now that I'm at 30 shares of Apple and I'm at the 10 shares of Microsoft still, you see the trims on this one. The trading on Microsoft from my end looks like quite a bit prettier. But what am I saying? So you see these trims, and my ideal scenario is I'm done trimming Microsoft and Apple stock, for the foreseeable future. I don't want to touch these. My tech allocation as of now is already, way down from what it was a year ago. Way down. Okay, I was overweighted in tech as compared to the S&P 500 this time last year. Now I'm underweighted in tech compared to the S&P 500. I think I have half the tech exposure in my portfolio. I don't want to get too caught up in that school of thinking, but I want to leave Microsoft and Apple on and kind of, weather any sort of correction. And the reason for this is I fear if I start trading and trimming too much, trying to time, other entries, I'm going to fall into this camp of, over managing my money. And, when you get in the habit of over managing, it's a very easy way to lose sight of your long-term goals. And it's a very easy way to kind of stifle capital, okay? So for that reason, I'm done trimming Apple. I'm done trimming Microsoft. And I do kind of want to show, 7 months ago, got this video came out. I sold Microsoft stock and bought this instead. Tech bubble. Again, this is a slow moving game. Okay, this was 7 months ago. All right, so kind of my ideal scenario for tech right now is to kind of remain at that lower exposure than the S&P 500. And then eventually, when we do see kind of some of these guys come back, to the 200-week moving average, Apple, we see it, fully finish its correction. That's when I start picking up shares. And I don't know if it's going to be necessarily adding to either of these two, or if it's going to be building a new position in tech. I'll definitely have to do some due diligence into some of these others' names. Unfortunately, tech has made me more nervous over the past, I'd say, 3 to 5 years, just because it is, without a doubt, the fastest pace, the fastest changing, sector. Okay. There's always innovations from one company, innovations from other companies. And to me, and I'll say this in feeling, to me, it can weaken a moat around some tech stocks when there's so many other companies constantly innovating in constant competition. It can definitely weaken a moat as compared to something like Altria, we'll say, which has been performing great. as compared to something like Altria, where, you know, there's not really innovations to be made in cigarettes. Okay, does that make sense? I mean, yes and no, but I'm kind of using two stocks at opposite ends of the spectrum. Do we understand? Okay, so with that sell on Apple, as well as, you know, a dividend that came in the other day, as well as a $500 net new capital investment, I have freed up, you know, $1,777 of cash in this portfolio. So now it's kind of going to be the segment where, you know, I place these trades and then we review, you know, the portfolio afterwards. Okay. I do, you know, want to continue building out my Pepsi position in a large way. As you guys know, that's kind of been my main focus as of late. So I think we're going to go ahead and do let's see. I think we're going to go ahead and do we'll go with 8 more shares of Pepsi. And that'll take up, you know, a large chunk of my new capital. But hopefully... All right, so we'll go ahead and place that trade on Pepsi. Okay, there we go. And we got filled at the 153 mark. After that trade, we have, you know, $553 left cash in this portfolio that I am going to invest in this video. And I think I'm just going to go again. I'm going to go with Hershey. These have kind of been my main two that I've been buying as of late. And we will go ahead and do 2 more shares of Hershey. Okay, that leaves us with 191 cash. And I think we're going to go ahead and round out this with Pfizer. And we are going to do 7 shares of Pfizer. And then the new capital is perfectly reallocated. Let's do it, guys. And then we will go ahead and get into the portfolio overview. Okay, so after I... you know, place those trades, the portfolio is currently earning me an estimated income of $3,115 annually. That breaks down to the monthly average of $259. And let's go ahead and get into where that money is coming from. Guys, we will go ahead and sort by market value. Okay, as of late, Altria has been at that #1 performing spot. At a market price right now of 58. It's been my best performer. You know, it's been my best performer in the past 12 months in terms of dividends and capital appreciation. Okay, and it's not this sexy Nvidia. It's not anything. It's kind of doing work for my portfolio, staying out the way, but earning me a ton of income, guys. Over $1,000 in estimated income. Moving on, Hershey, that's HSY. At $13,020. I do expect this one to grow a lot, and I'm not too sure how many more shares I will be adding. We will have to kind of see what the market gives us. This is definitely one I'd be comfortable with taking, you know, north of 100 shares at some point, as long as it stays kind of down in this range and kind of stays, you know, consolidating at somewhat reasonable levels. I do want to continue picking this one up. Okay, so again, 72 shares now, paying me $395 in estimated annual income. Moving on, we got Realty Income Corporation at a market value of $12,227. Guys, that pays me $691 income, and that is my only monthly payer. Next up is Pfizer, $7,200 $234, paying me an estimated income of $478 annually. I do want to pull up this chart because I say it all the time, but okay, my cost basis on it is 32. So I am down, over $1,700 of unrealized loss on this one. But I say this all the time. I've been early on Pfizer, but I'm not necessarily stressed about that at all. Kind of how I spoke on earlier, trimming and kind of taking tranche by tranche off to kind of, lock in the best exit. Same thing here. Here's the flip side of it of Pfizer. I've been building this one out consistently. And, maybe that's due to the fact that it's kind of a lower price guy and I've kind of just thrown leftover capital at it. But there's been so many tranches of Pfizer I've built out, and I kind of want to continue building this one, hopefully to, 300 or 350 plus shares while it completes this reversal. Okay, then I'll be done with it. We'll move on. We'll let the dividends roll in. We'll see that capital appreciation and we'll revisit it down the road. So, I'm hoping it's kind of a situation like Altria where I build. Okay, positions where I want it to be. Now I let it do its thing. Okay, that's kind of what I foresee happening with Pfizer. But like I said, it's been a long time coming. There's a lot of conviction and, long-term determination involved with this game. Moving on, Starbucks. I actually got Starbucks this morning. I usually don't. I usually drink like Red Bull. But I don't know. I got Starbucks today. 70 shares, just over 7,000 market value, and it pays me $171 annually. I like that one. I've kind of slacked on due diligence on it, but it's Starbucks, so I don't necessarily know that there's a ton for me to visit right now, okay? It seems like a lot of the news on Starbucks is not necessarily relating to fundamentals of the company, and it's relating to a little more dramatic styles of investing than I personally partake in, okay? So Starbucks, it's good where it's at right now. Maybe I add a few if it kind of dips again. But as we can see on Starbucks, it's kind of been in, what am I doing here? Hang on. It's kind of been in a channel for 5 years now. You see what I'm saying? Boom, low, high of the channel, low of the channel, high of the channel, low of the channel, back to the high of the channel. Now we're correcting. Maybe I pick up a few more shares here when it's down back towards these lows again. But other than that, you can kind of see why I haven't been too terribly up to speed on Starbucks, because it's pretty much been a wide consolidation for five years now, seemingly. Okay, let's not get sidetracked on techs. Moving on, Pepsi, I'm going to build this one out in a huge way. Like, I really would like this to be at 100 shares. Some of those even numbers, I don't know, just make me happy. They're prettier. Ultra at 250, I'm done with. I would like to take Pepsi to, 75 to 100 shares within the next 12 to 18 months. And I think that is doable. We've talked about the Hershey goal as well. But that's at $6,736, paying me, $238 in estimated income. Moving on, and now we see here this Apple and Microsoft. Okay, this is weird. This is weird for me. Seeing these two guys as kind of, I don't even really count T-Row because it's such a small position for me. Seeing Apple and Microsoft as like my two, smallest positions. Is my mic not on? Oh my goodness. Hang on one second. Okay, we're using my laptop microphone, so I hope that I hope this audio is okay. This video kind of seems like a mess, but thank you guys anyway. So yeah, we see these being my two smallest positions. It's weird for me, but like I said, I'm done trimming these out of the portfolio, and we will revisit tech in the future. I will keep you guys updated as to kind of when I see tech as the next opportunity. Apple, $6,660, 30 estimated income. Okay, not huge dividends, but it has served the purpose of funding a lot of other positions by the ways of capital gains. Okay, Microsoft, same thing. $3,838 pays me $33 annually. Okay, I get it. Last but not least, T Rowe. It's another one that's been consolidating for a while. However, you know, my focus has been off of it because I've started building the position and it's still been in, you know, a pretty tight channel now for like 3 years. Okay, it's down towards the bottom of it, and I probably should aim to pick up a few more shares here soon. However, for me, it's a matter of, you know, doing the due diligence and kind of deciding, do I want my capital here or is it better, you know, in other opportunities? Okay, it's a matter of my own personal risk tolerance with the financial sector and, you know, things of that nature. Okay. Okay, so kind of just to wrap up this video and review, I do want to stress this is not, you know, the level of active management I aim to do, you know, in perpetuity. It's just there's been a lot of different opportunities lately come up. I have kept you guys updated on the channel, but, you know, I do want to get to a point where there's not really many trims going on. So I want to keep that in mind. I do want to drive this home, guys. Let's avoid letting emotions and chatter, let's avoid that clouding our judgment, and let's stay the course. Let's do what we do as dividend growth investors and capture, you know, the best opportunities. I mean, there's some names right now that could be presenting a once in a decade opportunity, guys, and it's your job to take advantage of these, to remain, you know, to remain in your conviction, to do what you do, and yeah, to master your own process, guys. Let's get it. Let's build wealth. If you're not yet subscribed, please do so. That would mean the world to me, guys, and I will catch you in the next one.